Hello, and welcome to the BioSyent Q2 and first half results presentation. My name is Rene Gorham, and I'm the Chairman, President, and CEO of BioSyent. I want to start today's presentation with a look at our sales, EBITDA, and net income after tax for the quarter ended June 30th. Our sales reached $5.6 million, which was a 29% increase versus a year ago. EBITDA reached just over $2 million, for a 45% increase versus a year ago. And our net income after tax was $1.55 million for a 53% increase versus a year ago. Looking at the same numbers on a 6-month basis ended June 30th, sales reached just under $9.5 million for a 16% increase versus the same period in 2016. EBITDA was up 21%. And net income after tax up 25%, reaching just under $2.5 million. You can see the delta there between EBITDA and net income growth, and that's essentially some of the work that we've been doing to establish our international business and a structure that is more tax efficient. We're starting to see some of that efficiency flow through to our net income. This is a slide that you'd be familiar with. It's a look at our last 20 quarters, so the last 5 years of the evolution of our pharmaceutical business. Pharma sales in Canada were up 16% in the quarter versus a year ago. Internationally, our pharma business was up 188% versus a year ago. You can see that we've now had sales in the last 10 consecutive quarters. And importantly here, I've often commented on the lumpiness of our international business. Once again, you can see that if you just follow along Q3 and 4 of 16 and then Q1, Q2 of 17, you can see the last quarter sales were significantly greater than the Q1 sales. I would say looking forward into the back half of the year, there wouldn't be quite as much lumpiness based on the order book that we've got and what we expect to see shipped by the end of both Q3 and Q4. So here's a little bit more color on our sales in the second quarter. Our pharma business reached $5.1 million, an increase of 27% versus Q2 of 16. That's made up of our Canadian pharma sales of $4.3, up 16% versus Q2. Further broken down in units, FeraMAX was up 8% versus a year ago. FeraMAX powder up 28%, RepaGyn up 29%, and Cathogel jelly up 32%. Internationally, sales reached about $700,000, up 188% versus a year ago. We picked up one new market, certainly not picked it up in the quarter, but we started shipping to that new market in the quarter, and we've now executed sales internationally in 10 consecutive quarters. Our legacy business performed well, in addition to the pharma business, with an increase of 54% versus the same quarter a year ago. On a 6-month basis, our pharma sales reached $8.7 million, up 16% versus the same period in 16. Once again, broken down to $7.7 million in pharma sales in Canada, up 9%. You can see here that FeraMAX on a 6-month basis is up 0.5%. So you recall after the first quarter, we reported that the trade, so our wholesale customers, one in particular carried some excess inventory exiting 2016. Then generally we had a contraction of the weeks or days supply that our wholesale customers were carrying to the end of March. We hadn't seen that kind of a contraction over that period of time. That had an impact on our primary sales. We measure something that we call demand sales, which would be shipments by our wholesale customers to pharmacies. And for the first 6 months of this year, shipments of FeraMAX 150 from wholesalers to retail pharmacy is up 11%. So it's quite a different number than the 6-month number that you see on the screen here at 0.5% growth. FeraMAX powder for 6 months is up 15% in units, RepaGyn 32%, and Cathogel jelly 24%. Our international business has reached $1 million over the first 6 months. That's essentially a doubling versus the year ago. For perspective, last year The business overall for the full year of 2016 reached just over $1.5 million. Based on what we've done so far this year, first 6 months, the order book that we have, we expect that business to continue to perform well and see now orders that take us through 70% growth versus the year ago period. Our legacy business, you can see the level of sales increase kind of moderated somewhat when you look at it over 6 months, up 23% over the first 6 months of 2017 versus 16. That business is doing well. As you know, we don't invest in this business. It's really a maintenance strategy. Last year was an exceptional year. It was a kind of a 1 in 10 type of year that we had on our legacy business. We expect this year not to reach the same level as last, but probably going to be the second best year in 10, just based on kind of orders, shipments and orders to date. In addition to some new business that we've picked up from an international market. Shipments for that have started in July and are going out, some additional shipments going out this quarter. So overall, we think that business will be close to last year's performance, but slightly below. So our launch products have got mixed results in their performance this year so far. The Agaton system is performing in line with management's expectations and our budgeting, not even expressing here as a percent because the base year just isn't applicable. So our units are up by 2x versus last year. But just to remind you, we relaunched atropine in Q1 of 16 and phenylephrine wasn't launched. We didn't start shipping until Q4. So we're really comparing apples and oranges here. We have to wait till 2018 to have some meaningful year-over-year percentage comparisons. Our Cysview business overall has not had a large top-line contribution in the results that we're reporting today. I can say there's a lot going on the marketing and sales front. We've cost-effectiveness study that was done by certain healthcare professionals, key opinion leaders in Canada, that was presented at the Canadian Urological Association meeting in June. It was also published in the Canadian Urological Association Journal in June, giving a base case for adoption of Cysview. We now have 2 hospitals that have adopted, though only one has implemented. The other is still waiting for some equipment commissioning, which should occur this month. In the quarter, we had 2 additional hospitals completed positive evaluations of Cysview, and we've had 4 additional sites have either schedule evaluations or have them actually in progress right now. Though adoption of Cysview in non-muscle invasive bladder cancer has been below our expectations, a lot has been done since we started promoting the product. From a standing start over the last year and a half, I've had over 20 Canadian healthcare professionals, urologists, perform TURBT surgeries using Cysview. It's now widely known. We're really just going through the machinations now of sales, what I call sales execution in its various forms to work towards implementation in multiple sites. I think we'd mentioned previously, but just as a reminder, we extended the Cathogel agreement with Montavit out to 2024. That business has been growing on a double-digit basis since we launched in 2012. We see it as really an underlying platform for our hospital business until the Agaton brand and the Cysview brand contribute on the top line to the overall growth of the business unit. In May, Ferromax was named for the second consecutive year the #1 recommended iron supplement brand in Canada. This was a survey done by a division of Rogers Media. It's called Ensemble IQ Healthcare. They surveyed over 2,500 Canadian physicians and pharmacists. What's interesting here is that the percentage of both physicians and pharmacists surveyed naming Ferromax #1 increased in 27 from 2016, and this in the face of ongoing competition and competitive effort in the marketplace. So we've continued to build the Ferromax brand. We We have a lot of equity in that brand, and you can see in our sales performance that is playing out in the marketplace as well. We buy IMS data on a lag basis. The data that we have from IMS shows our share of market has hit an all-time record in 2 consecutive quarters. So as we move forward through the balance of the year into 2018, 2019, what do we see as driving growth in our business? So we still have some growth to come from existing products, FeraMAX, both in Canada and internationally from existing customers. Cysview, obviously, there's a significant amount of growth to come from that business. Cathogel, Repagyne, and the Agatelin system. We also have new products and new markets. So the new markets would be FeraMAX international markets. We're just completing the preparation of a drug, an RX dossier for FeraMAX. That will be ready by the end of this quarter to submit through partners into 4 new international markets for regulatory approval and then therefore access to those markets. Counting from the end of this year going forward about 18 to 24 months, that should open up 4 new markets for us going forward. We have 2 cardiovascular products, prescription products, being submitted to Health Canada by the end of this quarter. We're looking towards 2019 for launch there, obviously upon Health Canada approval, but right now it's in our planning for 2019. We submitted a women's health prescription product to Health Canada in May and are going through some dialogue and correspondence with Health Canada at the moment, and are looking now to a launch that will likely occur in the first half of 2019 on that new product. And as we've been reporting, we've got a number of initiatives to continue to expand our portfolio, and we'll announce those as they are consummated. This is a snapshot of the balance sheet. Our working capital grew 14% from December 31st of 2016. It reached $17.23 million. Our cash and short-term investments grew to $14.7 million, up 7% from December 31. Something new here that we wanted to highlight. The board of directors of the company has approved and implemented a loan program for certain senior managers in the company. A total of $391.5 thousand has been loaned to senior managers secured to purchase shares of BioSyent in the open market. The funds were advanced. The trades were executed by a third party in the month of June and have been reported under insider trading, but I can tell you as a group, just over 48,000 shares of BioSyent were purchased by that management team in the open market at about $8 a share. Finally, on the debt side, not much to report other than a continuation of zero debt, both short-term and long-term. Our operating line of credit remains in place with the Royal Bank. We don't use it. We leverage our cash position to run our business, and we have no long-term debt. So I just want to take a quick look at our cash generation for the first 6-month period. You can see the evolution from 2015 through 2017. Our cash on June 30th of 2015 was just under $7.5 million. And the cash generation for the first 6 months was negative, a little over $500,000. By this date in June 30th, I should say, in 2016, that cash position had grown to just under $10.5 million, an increase of $740,000. By this June 30th, 2017, reached $14.7 million. Obviously, positive cash generation. We're able to translate our revenue growth into profit growth, and that profit growth into cash. I know that there's a lot of interest in our plans and our intentions around deploying the cash that's on our balance sheet. We continue to work hard on looking at accretive and business building opportunities to deploy that capital. We're going to pick our spots, and we're working hard on that. And we expect that as the market evolves, that those opportunities will present themselves. Our return on equity for the 12 months ended June 30th reached 33%, so that's up from the 12 months ended December 31st, 2016. And if you net the cash out of that, I know that there are some that are not too keen on that way of looking at things. Our ROE would have been 129%. But the way we look at that is that we're going to deploy capital in the right opportunity. Certainly what we have on the balance sheet now is not used in the operation of our business. So another way to look at it is to do that calculation without the cash. Looking at our earnings per share. So this chart just shows you most recent 4 quarters versus previous 4 quarters. So in the year ending June 30th, we generated EPS fully diluted of 33 cents. That was made up of 11 cents in the quarter just ended. And if you compare that to the year ago quarter of 7 cents, a significant increase. Quite frankly, the net income growth that we've had translates into EPS because we so diligently take care of our share count. 33 cents versus 27 cents, up 22% on a TTM basis. Quick look at our information on the TSX Venture. Just to point out that our share count says 14.476 million and change, a small number of share options outstanding. For those that pay close attention to us, you'll know that we have not done an equity financing at BioScience since 2002. Wanted to take this opportunity to thank you for your continued interest in BioScience, your support. We look forward to continually reporting our progress in our business, growth, and execution of our long-term strategy. Thank you.